Silver investors? Something broke in the system, and almost nobody is talking about it on the front page yet. Today, the most important silver story is not a random candle on the price chart. It's the fact that the futures exchange that prices silver for the whole world, COMEX, is walking into March 2026 with hundreds of millions of ounces promised on paper, and barely a fraction of that sitting in the deliverable vault category. I'm OG John AG, and in this video, I'm going to show you what just changed in the COMEX data, why the March contract is turning into a live stress test for the entire paper silver system, and what that means for you if you hold physical ETFs, or you're still trusting paper promises going into this crunch. Segment 1. What just changed today? The live COMEX setup. Let's start with the today part. This is not some 10-year theory about one day silver will moon. This is a dated event with a clock on it, the March 2026 COMEX delivery period. As of the latest data, March 2026 open interest is about 429 million ounces. That's the size of the paper stack. COMEX registered silver, the inventory category that's actually designated as deliverable, is roughly 103.5 million ounces and shrinking. February 2026, which is supposed to be a small, quiet month, is seeing a delivery rate of around 98%, 18.72 million ounces delivered out of 19.11 million that were open. In a normal futures market, most contracts roll forward or close out. Here, almost everyone is standing for delivery. That's not how a relaxed paper market behaves. That's what you see when an exchange stops acting like a place to speculate and starts acting like a distribution point for scarce metal. Add one more detail. COMEX inventories have been draining at about 785,000 ounces per day. If that pace continues from early February into first notice day on February 27th, registered silver could slide from 103.5 million down toward roughly 85 million ounces just as March deliveries begin. So what changed today? The combination of a massive 429 Oz March paper position, a tiny and falling 100 Oz deliverable stack, and a small month like February running 98% delivery is telling you this is no longer business as usual. It's a live squeeze test of how far the paper system can go before it has to admit, not everyone is getting metal at this price. Segment 2. Quick refresher, paper versus physical, in simple language. Before we go deeper, let's get one thing clear. COMEX is a futures market. It was built primarily for hedging and price discovery, not to deliver metal to every holder of every contract. Two words matter here. Open interest. How many ounces are promised on paper? Registered inventory. How many ounces in the warehouses are actually tagged as available to fulfill those promises? There is also eligible metal, which is just silver stored in COMEX-approved vaults, but not committed to delivery. The owner has to voluntarily move it into registered status. In normal times, only a small slice of contracts, maybe a few percent, go to delivery. Most traders roll forward, close out, or settle financially. That's how you can have a big open interest number without ever needing to deliver all that metal at once. But when deliveries explode, registered inventories drain, and more people stand for physical instead of rolling, the futures market stops being a harmless paper casino and turns into a pipeline that pulls metal out of the system. That's exactly what the 2025-2026 data is showing. Segment 3, 2025. The year deliveries went vertical. Now let's look at the buildup. 2025 wasn't just a hot year for silver's price. It was the year COMEX deliveries went into overdrive. Using the breakdown that analysts have pulled from CME reports, 2024 total COMEX silver deliveries were around 203 million ounces. 2025 deliveries jumped to about 474 million ounces, more than 2x in a single year. It wasn't just one crazy month. Month after month, 2025 deliveries beat their 2024 counterparts. That's not a normal blip. That's a structural shift. People started using COMEX less as a place to flip contracts and more as a source of physical metal. At the same time, we know from flow analysis that silver had a violent speculative episode. Prices surged into late January 2026, peaking around $121.64 on January 29th. Then the metal collapsed over 40%, wiping out the entire year's gains and marking the steepest drop since 1980. A single session saw a 15% down day, driven by forced liquidation as the dollar spiked after the nomination of hawkish Fed Chair Kevin Warsh. The key point, even with that brutal crash, investors weren't running away from silver metal. They were running away from over-leveraged positions, while big players quietly kept using COMEX to pull bars out. Segment 4, January and February, 2026. The warning shots fast forward into 2026. 2 months, January and February, turned what used to be a theory into hard numbers. January 2026. Normally a sleepy month. This time, COMEX delivered about 49.4 million ounces of silver in January alone. That's about 7.27x what January 2024 saw, and over 4 rocks the January 2025 level. Translation: investors didn't wait for the big delivery month. They front-ran it, taking metal early. February 2026, small month, big signal. As of early February. February open interest, around 19.11 million ounces. Deliveries, about 18.72 million ounces, roughly 98% of that open interest. Think about that. In a market that's supposed to roll positions forward, almost every contract is turning into a demand for physical metal. Overlay that with the inventory. Registered silver has already fallen from roughly 167.7 minus Oz in October 2025 to about 103.5 minus Oz by early February. At a 785k Oz per day drain rate, you're staring at the possibility of only 85 minus Oz of registered metal by the time March delivery starts. January and February together are the warning shots. They show you behavior has changed before the big March showdown even begins. Segment 5, March 2026, the brutal math. Now we get to the heart of the story, the March contract. Here's the core setup. March 2026 open interest 429 million ounces as of early February. Registered inventory 103.5 million ounces, drifting lower. Ask a very simple question. What happens if people behave in March the way they just behaved in January and February? Run a few scenarios. 10% of March contracts stand for delivery demand 43M Oz. COMEX can probably scrape through, especially if some eligible metal converts to registered. 25% stand, which is not crazy given recent trends. Demand 107 Oz, already more than the 103.5 mil is currently registered, and more than what might be left if we slide toward 85 mem by first notice. 50-70% stand, in line with the intensity that gave you a 98% rate in February. Demand 215-300 mil Oz. Against that, you're looking at 85-103 mem registered ounces at best. Those numbers are not opinions. They're straight arithmetic on COMEX's own reported data. This is why analysts are calling it a potential COMEX silver crunch and saying March 2026 could break the system, not necessarily meaning a dramatic public collapse, but a moment where the exchange either has to dramatically change behavior, margin hikes, engineered price slam, forced rolls, or acknowledge that at current prices, not everyone who wants bars is going to get bars. Segment 6. How a system like this usually defends itself. So what does a system like COMEX do when the math starts to look like this? Historically and logically, there are a few levers. Smash the price, raise margin requirements, tighten conditions, push leveraged longs to puke their positions. Goal, reduce the number of contracts that stand for delivery by making it too painful to hold. Encourage or force rollovers, incentivize big players to roll to May or July instead of demanding metal now. Again, the aim is to reduce immediate delivery pressure, cash settlement, just alternative settlement pressure, offer cash premiums instead of bars. This doesn't show up as a headline default, but it tells you the system prefers paying dollars to parting with metal. Tap eligible inventories. Try to convince owners of eligible silver to move it into registered. But remember, that requires owners to agree. Many of them have metal in those vaults precisely because they don't want to play delivery games. None of these options are free. Every lever used sends a signal about what's really scarce, paper contracts or physical ounces. Segment 7, where the 40% crash fits into this. Now let's plug the price crash back into the story. According to the flow analysis, silver plunged over 40% from that January 29th high around $121.64. A single 15% down day highlighted just how leveraged and fragile the long side had become. The driver wasn't a sudden collapse in industrial demand. It was a dollar rebound and a repricing of Fed policy after Kevin Warsh, seen as hawkish, was nominated as Fed chair. Here's the key twist. Price action screamed bubble popped to the casual observer. Delivery and inventory data quietly said metal is still leaving the building. In other words, the crash flushed out speculative froth. It did not rebuild comfortable inventories or erase the structural demand for physical silver. That's exactly the kind of disconnect that long-term investors look for. When price sends a panic signal, but the plumbing of the market, COMEX deliveries, vault draws, sends a scarcity signal. Segment 8, what this means for silver investors. Practical lens. Let's bring this back to you. What do you actually do with a setup like this? A serious investor doesn't try to guess the exact day COMEX might blink. You build a framework and position size accordingly. Key points. Time horizon. If your horizon is 2 to 5 years, the real question is, will the mismatch between paper promises and available physical plus the macro stress around debt and rates be better or worse a few years from now? If you think the pressure grows, then periods of violent downside, like a 40% crash, are not proof the thesis is dead. They are accumulation windows if you know your risk. Position sizing and entries. Never go all in at one price. Scale into fear, accept that silver can overshoot both ways, and keep dry powder for engineered dumps. Vehicle choice, physical versus paper. Physical silver, slower, heavier, but no counterparty risk. It doesn't care if COMEX tweaks a rule. Paper, ETFs, miners, futures. More liquid and more leveraged, but exposed to exactly the kind of delivery, margin, and settlement games we've been talking about. Your edge is not predicting when the crowd wakes up. Your edge is understanding what the COMEX data is already saying before it turns into a headline. Segment 9. Final word. Why you needed to see this before March. So why am I saying you needed to see this now, not after March? Because what's happening here is not about one scary chart or one viral tweet. It's about confirmation. Delivery numbers confirming that more participants want metal, not just exposure. Inventory data confirming that registered silver is being drawn down into a tight window. Price action confirming that the system will happily smash the nominal price to protect itself, even as the physical story tightens in the background. If you wait for mainstream headlines to say, COMEX under stress, silver shortage confirmed, it means the easy accumulation window is already gone, the panic bids have already arrived, and you're just another late buyer chasing vertical candles. You've been watching John AG here, and I'm OG John AG. If this helped you see behind the daily price noise into the actual plumbing of the silver market, hit like so this kind of content doesn't get buried under meme trades. Smash subscribe and turn on all notifications. We're going to track the March data in real time and separate signal from hype. And drop a comment, metal in hand or paper in hope. Tell me where you stand after seeing the math, and more importantly, why. Because on this channel we don't follow narratives, we follow the numbers. अगर चाहो तो next step में मैंने इसी script के लिए Urdu English mixed on-screen text cues, B-roll ideas, charts, vault shots, COMEX reports, zoom-ins और short description plus tags भी ready कर सकता हूँ.